Hey, what's up, my friend? So, in today's episode, I want to talk about trading psychology mistakes, how your mind is tricking you to become, right, a losing trader. Okay, so there are a few things to be aware of. Number one, FOMO, otherwise known as the fear of missing out. So, what happens is that, you look at your charts and you see, oh man, what a huge bullish breakout, right? Look at the size of the candles, right? Look at the bullish momentum. And then what do? You buy because, the market is so bullish, right? Look how strong the move is, right? The market, it's definitely, right, it's guaranteed, right, to at least, go up higher. So you buy. And the problem with buying right after the market has made such a huge move within a short period of time is that number one, there's no logical place for you to set your stop loss, right? Because if you look at the charts, right, the nearest swing low is going to be quite a distance away, and most of you wouldn't set your stops right based on the market structure, based on the nearest swing low, because the stop loss is too wide. So what do? Well, you just place any random stop loss on your chart, maybe 50 pips, 100 pips, or whatsoever. As long as you have a stop loss, right, you feel safe, right, because there's something there to ensure that trade. But what happens is that the market doesn't care, where you set your stop loss, right? It's just going to do what it's going to do. And more often than not, the market will do a pullback. Okay, after moving a lot, right, it needs to take a break. It does a pullback. And because your stop loss, right, is at a random level, right, it will likely get triggered on the pullback. So yes, you can get a trade direction right, but if your stop loss is at a ridiculous level, a random level, then you're still going to get stopped out anyway. And this happens very often, right, when you have the fear of missing out, when you're chasing the markets, right, when you have no logical place to set your stop loss. When the market does any slight pullback, you get stopped out. And that is the first mistake, fear of missing out. So the key guideline that I have for you is that if the market looks really bullish, when your heart tells you, man, it's time to get in the trade, before I miss the next wave, that's probably too late to enter the trade. Number two, the mistake, right, that traders make is that, they feel good about a trade. Right? Oh man, this trading setup looks good, right? All the stars are aligned, right? The moon, the sun, everything's all coming together, right? Let me put on a larger size. Let me risk more per trade. So maybe you usually risk 1-2% on a trade. But this time around, because everything looks good, you risk 30-40% of your account on that one trade. And here's the thing, right? No matter how good a trading setup looks, no matter how many stars are aligned, I don't care. There's always a probability of a loss. And if you are going to manipulate, right, your risk management in such a way based on how you feel, what happens is that if that trade turns out to be a losing trade, you can imagine that you're going to lose a huge chunk of capital. 30-40% of your capital is just wiped out based on a trade that actually looks good. So you can actually be executing your trades, right, correctly for the past 10, 20 trades, right, accumulating, little losses, little gains along the way, but because of that one trade, you feel good, you over leverage, you over risk. That one losing trade wipe out all your gains that you have, earned over the last few months. So can you see where I'm coming from? So number two, right, don't position size, don't put on too much leverage, right, based on how you feel or how good the trading setup looks, right. Every trade, it has a normal distribution between wins and losses, right. Every trade, there's a possibility of it being a winner or a loser, right. No matter how good it looks, right, there is always a probability of a loss, and you have to take it into consideration. And that's why every trade that you put on, right, you have to risk, right, that same amount on every trade. If you are going with 1%, every trade, it's a 1% risk, 1% risk, 1% risk. Moving on, number three, you follow the news. Okay, so what happened is that you put on the trade. Maybe you have a long trade, and you read the news that, oh man, there's bearish news, right? Trump tweeted something, right, and it's bearish for the markets, and you get scared. Right, you get scared because of all the news, right? Breaking news, all in red color, and you start to doubt yourself. You start to doubt your trading plan. And what happens, right, is that you will start to take actions, right, that are actually outside of your trading plan. So you can imagine this, right? Your trading plan has been defined, ahead of time. But if you do not follow your trading plan, if you get affected by news, you can see that you're no longer following the trading plan. Your actions are no longer consistent. And if you do not have a consistent set of actions, you're not going to get a consistent set of results. Okay, so the news, right? I know it's difficult to turn off the news, but you have to switch it off. You have to trust the plan. You have to trust the process that you have already developed for yourself, right? And then just execute the trades. The news is just a distraction. And let me share with you a secret, right? So here's the thing about news, right? If you look at news out there, right, whatever news outlet, right? For example, S&P, is bullish for the day. Have you ever wondered how the news person, right, can quickly come up with the reason for that bullish news? Have you thought about it? Right? How are they, able to develop the reason so quickly? And the reason they are able to do it is because, right, before the market, closes higher for the day, before the market closes lower for the day, they have kind of like a template in front of them, right? A set of news, both good news and bad news, meaning they have reasons for both sides of the story. So if the market closes bullishly, they will read the good news. If the market closes bearishly, they'll read the bad news. So in a way, you can actually say that the price leads the news, right? Once the market has made a move, right, then this news, the media, they will find the relevant news, right, to fit into the price action for the day, right? And that's how it works. Moving on, right? Number 4, following the analysis of somebody else, right? So this again is a problem, right? I know it's tempting, right? You put on a trade and you go to maybe Twitter, you go into Facebook, and you realize, oh man, someone is taking a trade that is opposite the trade that you just did. Maybe you're long goal and the person is short goal, right? And the person maybe is a guru, right, whom you respect. But here's the thing, right? It doesn't matter, right, what someone else is doing because of 2 reasons. Number 1, the trading style could be different. Maybe you're a trend follower, whereas the person is a counter trend trader. Then clearly, right, your trade is unlikely to be going in the same direction. Number 2, the two of you could be trading off different time frame. Maybe you're trading off the daily time frame, whereas the person is a short-term trader trading off the 5 minutes time frame. And again, you can see that that's where your opinion, that's where your trading direction will diverge. So again, don't be concerned with yourself if you know what other people are doing. The main thing you should focus on is your own trading plan, your own trading strategy that you have developed. And finally, the last thing is what I call confirmation bias. Well, I didn't call it, right? The term is called confirmation bias. And how this works is that when you're in a trade, and let's say you're long stocks, right? You're bullish, you bought stocks of maybe Microsoft, and you long stocks, and you realize that the share price is falling, is moving against you, but you're still long. So what you do is you go down to Google, right? Search for Microsoft news, right? You look for Microsoft bullish news, right? You find reasons, right? Bullish reasons to hold on to the trade. And I can assure you, right? Whatever piece of news that you want to find on the internet, you can find the good side and the bad side of it. So what you'll do is that with confirmation bias, you will look for bullish news on Microsoft to kind of support your trading idea. So what happens is that as the price move against you when you're supposed to get stopped out of the trade, right? You still hold on to the trade longer than what your plan says so, because you are looking for news to confirm that initial trading idea that you had. And if you do this, right, your losses will no longer be 1-2% of your trading account. Right? If you do this, right, your losses could now be 10-20% because you hold on to the trade, right, longer than you should, based on your confirmation bias, based on looking at news, looking for opinion, right, to support your original idea, and that is a disaster. Okay, so with that said, right, I hope this makes you aware of the trading psychology mistakes that many traders make, right? And be aware of it and don't commit to it. So with that said, I have come towards the end of today's episode. Thank you, and I will talk to you soon.